It wasn't just a crash, it was the day optimism died. For a decade, America had been on a wild, non-stop party. The Roaring Twenties, they called it. Jazz music filled the air, hemlines went up, and stocks, well, they only went up. It felt like a new era where everyone, from the factory worker to the Wall Street banker, could get rich quick. But on a fateful day in October 1929, the music stopped. The dream shattered, and the world plunged into an economic winter that would last for a decade. This isn't just a story about numbers on a stock ticker. It's the story of how a nation's boundless hope turned into its deepest despair. So, how did it happen? How did the greatest economic boom in history lead to the most devastating bust? Let's rewind the clock and uncover the real story behind the 1929 Wall Street crash. To understand the crash, you have to understand the high. The 1920s were a period of incredible technological and social change. Mass production, pioneered by Henry Ford, made cars affordable, radios connected households across the country, and cinemas became the new temples of entertainment. America felt like it was on top of the world. This feeling of prosperity and endless possibility spilled over into the stock market. People saw stocks as a one-way ticket to wealth. Grandmothers, shoeshine boys, your local butcher, everyone was talking about stocks. And for a while, they were right. The market climbed and climbed, creating a dizzying sense of euphoria. The Dow Jones Industrial Average, a key measure of the market's health, nearly quintupled in just 5 years. Financial gurus and economists of the time declared a permanently high plateau for stock prices. They believed the old rules of economics no longer applied. America had entered a golden age, and the stock market was its shining symbol. But beneath this glittering surface, dangerous cracks were forming. One of the biggest problems was something called buying on margin. Imagine you want to buy a $100 stock, but you only have $10. In the 1920s, a broker would happily lend you the other $90. As long as the stock price went up, everyone was happy. If it rose to $150, you could sell it, pay back the $90 loan, and pocket a cool $50 profit on your initial $10 investment. That's a 400% return. It seemed like a foolproof way to get rich. The problem, it only works if the market goes up. If the stock dropped to, say, $80, you wouldn't just lose your initial $10. You'd still owe the broker the full $90. The broker would issue a margin call, demanding you pay back the loan immediately. If you couldn't, they'd sell your stock to get their money back, pushing the price down even further. By 1929, billions of dollars in these margin loans were propping up the market. It was a house of cards, built on borrowed money and blind faith. Another issue was the disconnect between the stock market and the real economy. While stock prices were soaring into the stratosphere, the foundation was shaky. Industries like agriculture and coal mining were struggling. Farmers faced falling prices and mounting debt after the boom years of World War I. The first tremor hit in September 1929. After reaching its all-time peak, the market suddenly dipped. A prominent economist, Roger Babson, gave a famous speech warning, "Sooner or later, a crash is coming." For a moment, the partygoers paused, but then the market recovered slightly. The optimists declared it a minor hiccup, a healthy correction. Charles E. Mitchell, the head of National City Bank, one of the most powerful banks at the time, confidently stated that the market was perfectly sound. People wanted to believe the good times would never end, so they ignored the warnings and jumped back in. But the confidence was brittle. The air was thick with a nervous tension that everyone felt but nobody wanted to admit. The market became incredibly volatile with wild swings up and down. It was like a tightrope walker beginning to wobble, desperately trying to regain balance before the inevitable fall. Then came Black Thursday, October 24th, 1929. The day began with a wave of panic. Prices plummeted from the opening bell. The ticker tape, which printed stock prices, fell so far behind that investors had no idea how much money they were losing. The gallery overlooking the New York Stock Exchange was filled with anxious onlookers, watching in horror as fortunes were wiped out in minutes. The noise on the trading floor was a deafening roar of shouts and panic. To stop the freefall, a group of top Wall Street bankers, including representatives from Morgan Bank and Chase National Bank, pooled their resources. They began buying up huge blocks of stock to show their confidence in the market. It was a bold move, and for a short while it seemed to work. The market rallied in the afternoon, and the day ended with only a moderate loss. The New York Times reported that the bankers had successfully stemmed the tide of panic. But it was only a temporary fix. They had plugged a hole in a dam that was about to burst. The weekend offered a brief, deceptive calm, but underneath, the panic was simmering. People had 2 days to think about their margin calls and the terrifying possibility that their life savings were on the verge of disappearing. The bankers' intervention on Thursday hadn't inspired confidence. It had confirmed just how fragile the situation was. When the market opened on Monday, October 28th, the floodgates opened. There were no powerful bankers to save the day this time. Selling was relentless. The market dropped by a staggering 13%. It was a bloodbath. But the worst was yet to come. The next day, Tuesday, October 29th, 1929, would go down in history as Black Tuesday. It was the day the dream officially died. From the moment the opening bell rang, it was pure, unadulterated chaos. A record-breaking 16.4 million shares were traded as everyone tried to sell at any price. There were simply no buyers. The system completely broke down. Prices collapsed. It was a financial apocalypse. Men who were millionaires in the morning were destitute by the afternoon. Stories, some true and some exaggerated, spread of ruined investors jumping from office windows. The Roaring Twenties were over. The crash was not a single-day event, but the start of a long, painful slide. The market continued to fall for the next 3 years. By the time it finally hit bottom in 1932, the Dow Jones had lost nearly 90% of its value. But the impact went far beyond Wall Street. The crash triggered a domino effect that crippled the entire global economy. With their savings gone, people stopped spending money. This lack of demand forced factories to shut down and lay off workers. Unemployment skyrocketed, reaching 25% by 1933. 1 in 4 working Americans was out of a job. Banks, which had also invested heavily in the stock market and made risky loans, began to fail. When a bank failed, its depositors lost everything. People rushed to withdraw their cash, causing even more banks to collapse in what are known as bank runs. International trade dried up as countries, including the US, enacted protectionist tariffs, trying to shield their own industries, but ultimately making the global situation much worse. The Great Depression had begun. What can we learn from this catastrophic event nearly a century later? The 1929 crash serves as a timeless cautionary tale. It teaches us about the dangers of herd mentality, where people follow the crowd without thinking for themselves. It shows the incredible risk of excessive speculation and borrowing of buying on margin. When everyone believes prices can only go up and they borrow heavily to bet on that belief, it creates a bubble that is bound to pop. The crash also highlights the importance of a strong connection between financial markets and the real economy. A healthy economy needs more than just high stock prices. It needs fair wages, widespread prosperity, and sustainable production. Finally, it reminds us of the critical role of regulation. The lack of oversight in the 1920s allowed these dangerous practices to run rampant. In the aftermath of the crash, major reforms were put in place, like the creation of the SEC to police the stock market and the FDIC to ensure bank deposits to prevent such a disaster from happening again. The story of the 1929 crash is a human story. It's about the intoxicating allure of easy money and the devastating consequences of collective delusion. It's a reminder that markets are driven not just by data and charts, but by human emotions, greed, and fear. The Roaring Twenties was a decade of unprecedented optimism, a belief that the future would be endlessly better than the past. The crash shattered that belief, replacing it with a decade of hardship and despair. It's a powerful lesson in financial history, showing us how quickly fortunes can be made and how much faster they can be lost. Every bubble bursts the same way, with disbelief. Thank you so much for watching. This piece of history is incredibly important for understanding our modern financial world. If you found this video insightful, please give it a thumbs up and consider subscribing to the channel for more deep dives into the stories that shaped our world. And don't forget to hit that notification bell so you won't miss our next video. We'd love to hear your thoughts in the comments below. Stay curious, and we'll see you next time.